If you want to start Forex trading, but you have no idea about what is Forex, this is your full guide. I'll take you from a beginner knowing nothing about Forex to mastering the basics and being able to place your first trade. If anyone needs one-on-one mentorship, check out the description. This is Molham and let's get into it. Now, before we start, get ready because there will be a lot of new information to you, some terms that you've never heard about, some concepts that they are very new to you. So make sure to focus, stay away from all distractions, and make sure to take some notes because there's some information that you might get back to later. And also, if you struggle on any of those concepts, you can do more research if you want. You have the freedom to do that. It's always good to do more research on any other concepts that you think you don't get 100% correctly. The first question that comes to mind, what is Forex? What is the meaning of Forex? So Forex, also known as the foreign exchange, sometimes written as FX, or basically currency trading. It's a global market where all of the world's currencies trade with each other. So let's say you get to the airport and a lot of time, the first thing that you do is exchange money from your current currency to the country currency that you're arriving to. At that point, what you do is you exchange your money to that other currency. It's exactly what happens in Forex. So let's say I want to exchange euro for pound. I can do that. And I can go from, for example, American dollar to Canadian dollar. I can also do that. So basically, we are trading a currency for another. By the way, this is the largest liquid market in the world. So you have a lot of money. Now, second question that comes to mind is when is the Forex market open? So the Forex market never sleeps and it works 24 hours and about 5 days a week. And why is that? Because governments, corporates, and private individuals who require currency exchange services are spread around the world. That's why trading on the Forex never stops. The activity on the Forex market follows the sun around the world. So right from the Monday morning opening in Australia to the afternoon close in New York, at any point of the day, you can find an active pair to trade. Who trades the Forex market? Some of the participants in this market are retail, so people like me, you, anyone who wants to exchange his money to another currency or wants to make money, he can trade the Forex market. Banks are also a big participant in this market. So when banks wants to exchange from a currency to another, they use the Forex market and they also try to make money off it. Business owners, so let's imagine that there is a business that runs in different countries in the world, and in every country there is a currency that the market is following and using. Now, in order to, let's say, there is a main office in the US, then all of the money needs to be in US dollars. So, what's going to happen here is each location from a specific country, they're going to convert their money or they're going to trade it for another currency, which in this case is the US dollar, and they're going to send the money into the US bank account. It's going to be in US dollars. So, business owners can also use the Forex market to exchange their money to a specific currency. Now, what is a currency pair? It's basically quoting one currency against another. So let's say I want to convert between, or I want to actually exchange from euro to dollar to the US dollar. Then this is my pair. It's going to be euro and US dollar. The first currency is going to be the base currency, and the second one is going to be the quote currency. So if we look right here, we can see that the current, as of today, the current price of the Euro USD was 1.1015, which means that for every euro that I want to get, I'll be paying 1.1015 US dollar to get 1 euro. So that's the rate. So I'm basically paying this amount of money in US dollar to get 1 euro. In other words, when an order is placed for a currency pair, for example, the Euro USD, then the first listed currency, or actually the base currency, is bought, while the second listed currency in a currency pair is sold. Today's video is sponsored by Hanko Trade, one of the best brokers in the business with spread as low as zero, low commission, and you can trade all markets, including Forex, indices, and crypto. And if you use the link in the description, you will get an exclusive 100% bonus. Make sure not to miss it. Let's get back to the video. Now, we already know what a currency pair is, but we're going to know what are the types that a currency pair come as. So first of all, the major pairs, and this is why I trade the most. So what is a major pair? It always includes the US dollar. So if there is a pair that has a US dollar either at the beginning or at the end as a base or as a quote currency, then that means this is a major pair. So for example, we can see Euro USD, USD JPY. So this is the Japanese yen. This is the US dollar. This is the euro, and also AUD USD, which means the Australian dollar and the US dollar. Also GBP USD, the pound against the dollar. Those are the major pairs. Examples, it should always include the US dollar. Now, the cross in the opposite, it does not include the US dollar. So a cross pair, for example, Euro GBP, so the euro against the pound, this is a cross. And why? Because it doesn't include the US dollar. And we have GBP AUD. This one has no US dollar, which means that this is actually a cross pair. And also CAD, which is a Canadian dollar against the Japanese yen. This is also a cross pair. And why? Because it doesn't include the US dollar. Now, exotic, and I don't really recommend trading this because it's too risky. It doesn't have as much liquidity as the pair above, or it doesn't have as much volume, and they're actually very risky. So those includes one major currency alongside an exotic currency. So a currency from an emerging market or a developing country like Brazil, Mexico, Chile, and Turkey, all of those countries and some others. I don't really suggest trading on those. I really just sticking to the major and the cross. All of those have much liquidity and much volume to be able to trade with. Now, the real question comes how to make money from Forex. And I know that's the objective and that's the main goal of all of us, including me. I'm coming to the market. I really want to achieve the financial freedom. And I know that's what you're coming for. So, how do we make money from Forex market? So, we basically predict Forex pairs to profit from one currency, either strengthening or weakening against the other. For example, if I know that euro against the dollar, I know that the euro is going to be stronger, which means that price is going to go up. If I know that, I can actually buy the euro USD pair at a specific price and then wait for price to go up a little bit and then take my profit there or close my position there. The difference between the previous or the price that I bought at and the price that I close at, that's depending on the risk or the money that I put in, I get that profit. That's how I make my money. In other words and simple words, you can buy low and sell high, or you can sell high and buy low. The difference in the price, that's how we make money. And we measure this by pips. So in other words, also, we can actually make money from the Forex market by collecting pips or by getting pips. And we're going to go through the next slide and I'm going to tell you, and I'm going to be explaining to you what does a pip mean. Now, another word for buying is longing or buy and long. It's totally the same. Also, if I say short, that means sell. So those are just different wordings for the buy and sell. So long, short, buy and sell, it's totally the same. So simply, if we consider this as the euro dollar, for example, or any other pair, okay? If I sell here and close my position somewhere in here, I'm getting profit. If I buy here and close my position here, I'm getting profit. If I buy again here and close my position here, I get profit. And this could be in a 5 minute, this could be in 1 minute. Every candle could be specific time. So this could be only 1 minute, or it could be 5 minutes, or it could be 15 minutes. We can adjust on that. Now, if I sell here and price keep going up, I'd be losing. That's going to be the opposite. But if I sell here and then wait for price to go lower, or if I short here and wait for price to go lower, then I would be making some money. So that's the logic behind trading. If I buy here and wait for price to go all the way here and close my position here, I would be in maximum profit. I could actually double my money here or make 1%. It depends on the risk. Or I could lose all my money, or I could lose 1% of my money. And that's where we're going to go and look at the risk management later, because we can actually double our money or lose all our money in few seconds if you want in Forex. So Forex is very risky. We got to deal with it as a long-term thing. Now, as we discussed before, making money off Forex, in simple words, it's making or collecting some pips. And what is a pip? It's a measure of a change in value in a currency pair. So when we have a currency pair, we cannot say that, oh, it changed 5 cents, for example, because we have euro and we have a dollar. So we cannot just go and depend on the dollar, for example. Now you have different currencies. How do we measure the change? It's in pips. So pips is the smallest change in a value in a currency pair. And in most of the pairs, actually all pairs except the Japanese yen, and we're going to look at the exception later, but it's actually the change of the fourth decimal. So any change in the fourth decimal, one change is 1 pip. Now looking at the example here, so let's say Euro USD, the price as of now is 1.1014, and we can see we have 4 number after the decimal. So 1, 2, 3, 4, that's the fourth decimal. Now this, when it change from a number to another, one change in this number is 1 pip. You can see if we move from 1.1014 to 1.1015, so you can see that this number is changing here from 4 to 5. This means this is a 1 pip increase. Now another example here is the US dollar against the Swiss franc. So we can see that the price was 0.8552, but it changed to 0.8541. So the first question comes is, oh, do we have an increase or decrease? Actually, the values decrease 1 here from 5 to 4, and the other decimal, which is the fourth one, which is the pip one, changed from 2 to 1. So any change in the fourth decimal counts as 1, but the third decimal count as 10. So in this case, so this 2 changed to 1, which means that 2 to 1, that's a decrease of 1 pip. But when you look at the other decimal, this is the third one, and this counts as 10. So if it changed from one number to another number, and let's say it's 5 to 4, that means 10 pips. If it's 5 to 3, for example, that's 20 pips. So here it changed from 5 to 4, that counts as 10 pips decrease. So we have 10 and 1, which is 11 pips decrease. Now, this is just to explain, you're not going to be counting the pips every time. It's very easy. We have a lot of tools that counts the pips automatically in seconds. Now, we have one exception here. In a Japanese yen pair, it's actually the second decimal and not the fourth decimal. So in USD JPY, for example, this is the US dollar against the Japanese yen. The price is 142.450. And for example, a change here is 142.480. So as we know, the change here is the second decimal. So looking at the second decimal, it changed from 5 to 8. That's a difference of 3 in value, which means this is the 3 pips increase. So this is the only exception. Otherwise, it's always the fourth decimal. Now, what is lot size? And this is very important because this would be part of the risk management. We're going to know what is a lot size and is going to be used to enter the trade. So you cannot say, oh, I'm going to be entering with $1,000 because you're trading a lot of different pairs. Let's say Swiss franc and Canadian dollar. How do you buy this with a US dollar? You cannot. So the unit to measure the amount of the trade or the deal is called the lot size. And there are different tiers to this. Actually, there is the standard lot, and it consists of 100,000 units. There is the mini lot, and it consists of 10,000 units, and it's 0.1 standard lot compared to this. The micro lot is 0.01 lot, and it's 1,000 units. The nano lot is 100 units, and it's 0.001 lot. So you don't really need to be aware of all of those. Usually all I do is use the standard lot, and this is very easy. We're going to go over the example later how to execute a trade using the lot size, and we're going to know all of this. Now, the lot size and the pip value, there is a relationship between them. So for every standard lot you risk, there is a pip value for that. So for example, in Euro USD, and this could be different from a pair to another. So for example, if I risk one standard lot here, for every pip price moves, I would be making $10. And for one mini lot or 0.1 lot, standard lot, I'll be making $1 a pip. And this goes for the micro and the nano. And as I mentioned on the pip slide, we don't really need to pay a lot of attention to this because now we have tools that calculate the profits immediately and automatically. So no need to worry about this. You just need to have the basics overview about this. Another term that is so popular in trading, and I guess you've heard about it before, it's leverage. So what is leverage? It's basically having the ability to control a large amount of money using very little amount of your money and borrowing the rest. So let's say you have $1,000, but you're having the ability with the help of leverage to buy as you're buying with $100,000, for example. And it's expressed as a ratio. And another example is if a broker offers a leverage of 100 to 1, and as I said, it is expressed as a ratio. Now, if the broker offers 100 to 1, this means that for every dollar that you have in your account, you can actually take a position worth up to $100. So instead of $1, you can take a position worth up to $100. Now, this could be good for you or bad for you, and it depends on how you use it, and it depends on your risk management, how you are able to manage your risk. So let's say if you have $1,000 and you have 100 to 1 and you're risking 1%. So now this $1,000 with the help of a leverage of 100 to 1, it's gonna be 100,000, and 1% of that, because we are risking 1%. If you made 1%, then that means you're up $1,000. On the other hand, if you actually lose 1%, you're down $1,000. And this means that you actually lost your account because $1,000 is all of the money that you're having. You could have gotten more, so you could have gotten $1,000 here, but if you lose it, you lose all your money. Now, if we consider the same example, but without the help of leverage, then we have $1,000, we have 1 to 1, and as I said, we're risking 1%, so either making 1% or losing 1%. We risk $1,000 and we make 1%, that's only going to be $100 instead of $1,000. And if we lose that $100, it's going to be actually 900 here. So not 999, but it's going to be 900 right here. So we're only losing 1%, which is going to be 100 instead of losing the whole account. But here we made $1,000 instead of just making $100. So here is the difference. It can go good or bad for you, and all of this depends on the risk management. Now, if you decided to move with Forex trading and you want to place your first trade, how do you do that? Through what do you place that trade? And here comes the answer. Forex brokers. They are a financial services company that provides traders access to a platform for buying and selling currencies. So if you want to place your first trade, this is where you go, a Forex broker. And there are two types of Forex brokers. There is regulated and unregulated. The regulated one is licensed and monitored by a regulatory authority, and it is safer, it has a customer protection, but it has a limited instruments and a low leverage, as we discussed before. Now, the unregulated is not licensed and not monitored, and it actually lack of oversight, and it has a high leverage and more instruments. So the safer one is, of course, the regulated one. But if you want to go with one that is easier when it comes to the payment methods, but you're always at the risk of either, no transparency, you could lose your account, they could manipulate with your accounts. There's some brokers that do that, but it has high leverage and it has a lot of instruments. And that's why sometimes I do trade with unregulated brokers. And why? Because I could trade Forex pairs, I could trade gold, and I could trade indices or stocks all at the same time. In regulated brokers, you cannot do that. Now, just because the Forex market is open 24 hours a day, that doesn't mean that you need to trade every time, all the time, 24 hours. No, there are some times where the price action is going to be the best. There is time where the market is going to be active with a lot of Forex traders opening and closing position, which actually creates a large volume of trades. So this is the time where we need to focus and trade. Now, there are four main sessions when it comes to the Forex market. There is the Sydney, Tokyo, London, and New York. Each one starts at a specific time and ends at a specific time. For example, the Sydney starts at 3 p.m. right here and ends at midnight. There is also the London and New York. Usually, I do focus on London and New York. London starts at 3 a.m. and then ends at 12 p.m. And the New York starts at 8 a.m. and then ends around 5 p.m. So those are the times that I'm going to be focusing the most on, which is the London and New York. And if we can see the overlapping of the two sessions, the London and New York, we can see there is where the most volume is, somewhere in here. This is the overlapping of the New York and the London. This is where the most volume is. So I do suggest either trading the London or New York, because usually the Tokyo is a lot of time ranging, going to be in a range, but the London and New York is going to be more trendy. It's going to be a lot of volume in there. Now, there are some times where you'll come to the chart and you'll see a move, something like this, a big move, that has never done before. There is nothing similar to this candle, big candle, then going up more and more and more. So this is a very big spike in the price action, unlike the previous price action behavior. What does that mean? Usually, there is a news event here that is high in impact that caused the price to do this. And how do I know if there's some news that are coming soon or in this week or the next week? I would suggest a website that is called Forex Factory, and we're going to go over it in a second. But it tells you all of the news or all of the events that are happening in this week or the next week or the next month. And it tells you, is this high impact, very high impact, or not high impact? So you see different colors here. Usually I'll go with the orange and red because those are usually the high impact news. So when we have those high impact news, we can expect much volume in the market, price spiking up or down just because of this or the events. Now, if we just go to forexfactory.com/calendar, we can see this. We're having this calendar, and you can go to the next week, for example, or next month. So this is December 31st to January 6th. This is the week. You see, Monday we had no high impact news. Tuesday nothing. Wednesday there is this news right here, news event, and what currency is going to affect and what time is it. You can always change the time from here. You see 1:37. You can change the time from here, your time zone. If I go back, you can also filter the event. So if you click here, we can see that I'm only selecting the red and the orange one. I'm ignoring those and I'm only picking the dollar, GBP, and euro because those are my main pairs and this is what I trade. But you can always select more, apply filter, and you're going to see the news. You're going to see the details about all of the news events. What is the forecast, what is the previous, and all of the details right here actually. So this is how you stay updated on the market. You know what news events are in the next week or the next month. Now, in order to start trading, there are two main trading platforms that you really need to have, and one complete the other, and those are doing different jobs. So the first one is MetaTrader, and it's either 4 or MetaTrader 5. This is the platform that we're going to connect the broker details in, and we're going to be executing the trade. So either buying or selling, placing trades, adjusting the stop loss and the take profit and the trades, everything is going to be on MetaTrader 4 or MetaTrader 5. Now, the other platform is going to be Tradingview. And this is where we're going to go and analyze the price action, and we're going to be doing the analysis and everything. So basically we're going to do the analysis here, and that's my own way. You can always do it without the Tradingview, but I like Tradingview more than MetaTrader to do my analysis here and then execute on the MT4 or MT5. And MT4, MT5 is available on mobile or on the Mac and Windows, and also the same with Tradingview. I do use both at the same time. Analysis here, execution here. And we're going to go over those. But before, I need to cover one of the most important concepts before starting trading, and it is how to read the price action. So what used to be the price action, how it was showing, it was using a line. So there was just a line that present where price is going to, but it was not really that efficient to know a lot of details. So I don't know what happened here exactly at the specific time. Did price just go up immediately, or did it go up, go down, and then continue up? So I don't really know what exactly happened inside of the price action. And by the way, this is Tradingview. There are a lot of different ways to present the price action. So you see bars, candles, lines. This is the line. This is the one here. But there are a lot of different presentations of the price action. What is the most popular way to represent a price action? It's the Japanese candles. You're going to see this everywhere. And this is, as I said, the most popular way to represent the price action. What is the difference between the line and the Japanese candle? So a line is simply just a line, but this has a body and a line, and it will tell you what happened exactly at that specific time. Now, each candle here represents time. So the candle itself could be 15 minutes, or it could be 5 minutes, or it could be 1 minute. It depends on what the time frame that you're using is. It's basically used to describe the price action during the given time frame. So let's say This is, for example, a 5-minute candle, which means this one takes 5 minutes to open and close. Now, just because this is a bullish candle, a bullish means price going higher. So price opens here and closes here. This is now a bullish candle. Why? Because price did go higher in here. Now the candle opens here. It created a high, and this is now the shadow or the wick. It's called shadow or wick, and it closes here. The open and close is represented by a body of a candle, and then the high, the maximum price went to, and the minimum price is the low, and the high is represented by a shadow or a wick. The same goes here. This is now is a bearish candle. In a bearish candle, the scenario is price opening here, for example, maybe creating a high now or later. It doesn't really matter. But price open here, created a high, started going lower, and it created the minimum price went to. This is the lower shadow, or it's also the lower wick. And then price went up. As it was going up, it closes here, which means that this is now the close, this is the open, and this is the highest point that price reached in this specific time frame, and this is the lowest point. As you can see here, bullish candle, it opens here, created a low, went up, created the high, and then closes here. This is a bearish candle. In a bearish candle, this is where the candle opens, started going lower, it closes here. But in that time, it created a low and a high. But the open and close is right here and right here. Now, bullish is price going higher. Bearish is price going lower. So this is a bullish candle, bullish candle, bullish candle, because price did open here, but went higher and closes higher than the opening price. But this one is a bearish candle. And why? Because this is the opening price and it's lower than the closing price. So this is going lower. So this is bearish, bullish, 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 and then bearish candle. So now we're going to go over MetaTrader 4, how to use it, how to set up your account, and how to execute the trade, how to set a stop loss, take profit, and close trades in MT4 or MT5. Today we're going to go over MT4, but MT5 is much easier. So basically what I've done is I went to Google and I looked for free demo account, Forex trading, and I was able to get one just by putting my email and my phone number. So basically, I got the account number, password, and the server. So I'm just going to copy the server. I'm going to go to MT4. This is what we see here. We should have the price action here, the chart, and we see the symbols here, or basically the pairs or the assets that we can trade. So the first thing that we're going to do is go to the accounts, click on open an account. Now, sometime you're going to see the servers here ready for you. If you downloaded the MetaTrader 4 from the same broker that offers you the demo account, you're going to come here, paste the server, and click enter, and it's going to look for the servers. But I have mine here, so it's Think Markets Demo. I'm going to click on next, come to existing trade account. So I copied both the username or the login and the password, click finish. And now if we see the trade button here, or the trade, if we see the trade panel here, that means we're logged in. And now we're actually logged in. So it showed the chart here. We're going to go here into the market watch, and we see a lot of assets here to trade. Simply, we're going to go to, for example, Euro USD. Here is the one. I'm going to right click on this one, and chart window is going to actually show me the chart window here. So this is the chart. This is what I see here. Now I'm going to click here just to shift into the chart to the left a little bit. 4 hour, I can go to the 1 hour, and now every candle is 1 hour. But I'm going to go to the 5 minutes, and I'll show you how to open a trade. So basically, what we're going to do is click on here. There is a small arrow to the downside. It will show you the trade panel. Here, you put your lot size that you want to enter with. So let's say for now, I want to enter on 5 lots. 5 lots. And click on sell. I want to sell now just to try, because this is all demo money. This is all virtual money, not real money. First time you got to accept this. And I'm going to click again, actually with 15 lots instead, and click on sell. And we can see that we're having the balance here. So the balance is the money that we're having. Equity is the balance plus or minus the position that we're opening. And now we can see this is a sell trade. The size is the lot size. And what price did I enter on? Now it will show you the profit here. So we are minus 180 as of now. Now, let's say I want to set a stop loss here. How do I do that? The first way to do this is come here, click twice on our trade, put the stop loss price that you want to do, and the take profit that you want to take profit at. But this is a lot of headache. There is another way that's much easier to set your stop loss or take profit. Simply, this is our entry price. We got to drag this to the upside. For example, here, we want to put our stop loss here, leave it here, and there you go. We have our stop loss here and I show you our profit. So basically profit is going to be minus 1,300 and the pips is minus 91. The same way as we dragged our stop loss to the upside, we're going to go lower, drag it to the lower side. And for example, this is our take profit right here. If we go over it, it's going to show us we can have $2,280 in profit if price comes here. And if we see, for example, if I drag this somewhere in here and hopefully price touch here is going to actually exit the trade automatically without even doing anything. If I wanted to actually close this position right now, I'm going to click on this X button here. I'm going to close the position immediately. So close, it's closed. Now let's say I don't want to go market order because we know market order, if we click here, that's a market order. I want to have a sell limit. Sell limit means price that is above the current price. So if I just go above the current price, click here, sell limit. I have one here that is 15. If I want to adjust on this, I'll adjust it from here. So again, click here, sell limit, and we have the sell limit here, and we can adjust the stop loss and take profit. Now coming into the Tradingview part. So how to use Tradingview for beginners. We're only going to cover the basics, the most important things that you really need to know as of now. So you have this platform right here. You can use it on the mobile and you can use it on PC and browser too. So this is the Windows version. Now the first thing that we're going to look at, so we have this. We don't know anything as of now. What we're going to do is come here first and you have the simple search. So basically here you can write the asset name that you want to trade or the pair name. And for example, the most popular pair, as you know, Euro USD. So EUR USD, and we can see all of those are Euro USD. Why do I have a lot of those? Because the data are coming from different brokers. And we know that, for example, Pipperstone, ICE, those are the brokers that are offering the data to TradingView. And usually most of those are very similar to each other. So for example, if I go to Pipperstone, I can see the chart here. Here we have the different time frames. So we have 1 minute, 5 minute, 15 minute, 1 hour, and we have a lot of other ones here. And you can actually start the one that you use the most. Now, what does time frame mean? It means that this singular candle, the Japanese candle, is 15 minutes. If I go to the 5 minutes, we had different candles and we had different formation of candles. This singular candle takes 5 minutes to form. And then this next one is 5 minutes. And if you notice below, we have actually the timing, and this can be different to what time zone you're using. So usually I go with New York and I can know at what time in New York time zone is this happening. Now we can go in a different time frame, and here we have the indicators. You can actually take a look at those later. We have the different types of candles presentation, and we come here. Here are the tools that you can actually draw on the chart. So all of those, we have a brush, for example, this is a brush, and we have text, and we actually have a lot of different tools right here and things to put in the chart. For example, a trade. So for example, if you want to practice and put a trade here, for example, if you want to go buy somewhere in here, this is buy. You put your stop loss and you take profit anywhere in here. So this is the presentation, and this is, can be used to analyze your chart. Now, this is all self-explanatory. You come, you pick the one that you want to try, and you try it here. As I said, very self-explanatory. Now, let's say, for example, I have this text on star. I click on star, and we can notice that we are having this toolbar here, and it's having all of the tools that I usually use. So, for example, for a quick access, I have the brush here, and I can use it immediately. And then if I want a rectangle, I can use one here. When I click on this, there is another window that is appearing here, and I can actually pick the color that I want for the border and the color for the rectangle. So for example, this is another color and a lot of other options. Now, if I want to go in details and the settings of this rectangle. I'll click here and I'll go to settings right here, and I have a lot of other options to look at. Now, this is all not that important. The most important part is that we know that, oh, we can pick the time frame here. We can pick the asset or the pair or the symbol from here. Here are all the tools that I can draw here or show the, for example, the toolbar right here. And actually, if I click here, they can adjust on those. But my first one is the watch list. And here I have all of the pairs that I'm looking at now. So Euro USD, GBP USD, all of those pairs. I have them here. How to add one from here. So from this plus button, and pick the one that you want right here. And it's going to be added to here. So TradingView is really self-explanatory. You will learn a lot of things by yourself. But if you needed to know more about it and you're struggling, then you can watch a full video or a full tutorial on YouTube. You'll find a lot. There are some people who went deep into TradingView. There are two different ways to analyze the market. And below the technical analysis, there are many different ways goes below that. But we have technical analysis, which is the study of currency price movements on the chart. So basically, we're going to be looking at the chart and we're going to be analyzing how the price action goes. Does it make sense for price to go higher now or go lower? It depends on what I see on the chart itself. On the other hand, as we discussed on the news events, fundamental analysis is the study of economic data reports and news headlines and news events. So we're going to be looking at the news events and we're going to be looking at the data, the reports of the economic, and we're going to decide, oh, does it make sense for price to go up from here, relying on the data and the news headlines, or is it going to go lower? So as we said, sometimes we depend on the chart, on the technical analysis. So we depend on the chart and what is happening in the chart itself on the technical analysis, but we depend on the news events and the data reports on the fundamental analysis. Now, most of what I do is relying on the technical analysis, but I keep an eye at the fundamentals too. In order to be a successful trader, you need to be your own trader. You cannot follow someone else and think that you're going to be successful. No, you're not going to be. That's why you need to have a trading plan. So a trading plan covers everything on what is supposed to be done, why it should be done, and when it should be done, and how. All of those things are going to be on your trading plan. So let's say you are on Euro USD, for example. You're going to be looking at your trading plan based on what is happening on the price action. You're going to go on your trading plan and it's going to tell you what to do based on current price action. So what to do, why do we do that, when do we do, at what specific time, and how. Now, developing a trading plan and sticking to it are the two main ingredients of trading discipline and trading success. So if you want to be disciplined with trading, then you need to develop that trading plan, and it should be a good one. But you're not going to know if it's a good one or a bad one unless you stick to that trading plan. And you can go with a demo account, which is an account that doesn't have real money on it. You can test that trading plan and see. But the discipline itself, you can be disciplined by developing that plan and sticking to that plan. And I do have a lot of trading plans on my channel. So if you're really curious, you can check my other videos about trading plans, how to create one, and ones that I use myself. If you don't have a trading plan, you would be confused every time you look at the chart. Every time you look at the chart, you don't know what to do because you don't have a clear plan on what to do. So sometimes if price, for example, break above the last candle, you do what? If price breaks one of the highs, you do what? That's what trading plan tells you. Trading psychology. This is where a lot of people come to trading very excited, thinking they can make money very easily. But as soon as they enter the market or their first trade and see a loss, they'll have a lot of different feelings at the same time. It's totally normal to have that feeling when putting your money on the table, as there are risk of losing your hard-earned money. So trading psychology is the way our emotions and mindset influence our decisions when buying or selling, or when we are in a trade. It's very crucial because it affects how we react to a market changes. For example, feeling anxious when price drop or overconfident when price arise. So you see prices going up, you're getting very excited here. But as price going lower, you get anxiety, you get fear, you get a lot of feelings and panic. And then you see depression, and it's just coming back up. You get the hope again, you get the relief, all of those feelings. So as price going up or going lower, you have a lot of different feelings, a lot of mixed feelings. But we should be able to manage our emotions because our reaction can lead to impulsive decisions. Sometimes a wrong impulsive decision can lead to losing all our money in a single trade in few seconds, which is not trading no more but gambling. So we don't want to be going this way. Actually, this is not really the way to look at it. What we want is basically going something like this way. We want to be stable throughout the trade. As we are holding the trade, we don't want to go like this, but we want to go like this. Risk management, one of the most important concepts in trading, and you need to master this in order to be successful. Without this, you will never be successful. Why? Because you could lose all your money in one trade, or you could lose 50% of your money in one trade if you don't follow the right risk management. Now, risk management consists of two main rules, and based on my opinion, those are the two main concepts in risk management that you gotta be aware of. The first one is the risk and max loss. So basically, when I say I'm risking 1% of my money, what does that mean? That means in singular trade, I'm only allowed to lose 1% of my money. If it goes bad, and in other words, if it hits the stop loss, then I'm only losing a maximum of 1%. And I do suggest only risking half percent, 0.5% to a maximum of 2% a trade. That's the maximum you can do. And you might be surprised now, oh my God, do I only risk 1% of my money? Yes. Now, how do I know what is my risk and what is my max loss? We're going to be using a position size calculator, and it's going to be based on the lot size. So the lot size that we talked about before, we're going to calculate that lot size that is specific for this type of trade, and I'm going to cover this later. But the second part, or the second concepts that we really need to master, is the reward to risk. Now, everything in life, after mastering trading and after having, trading journey for about 5 years, I think about everything in a reward to risk aspect. Reward to risk and win rate are very related to each other, which means that now what is a risk to reward or reward to risk? It's basically if I'm risking 1%, I'm aiming for 1% in profit. This is a 1-to-1, which means that if I'm risking $100, I'm going to be able to make $100. But if I lose the trade, I'm losing 100. Now, sometime I'll go with 2-to-1, which means that the same $100 that I'm risking, I'm going to be aiming for $200. 3-to-1, it means that I'm aiming for $300 to $100 risk, which means losing $100. So this is a 3-to-1, 2-to-1, 1-to-1. And the relationship between the reward to risk to the win rate is right here. So we can see if we go with a 1-to-1 and we have a win rate of 50%, which means that 50% of the time we get it right, 50% we get it wrong, then we're going to be in break even. But less than that, let's say in a 40% win rate, we're going to be losing. So if we go and take 100 trade, all of them are 1-to-1, and we got 40 of them winning and 60 losing, then we're going to be in a loss at the end. Now, on the other hand, if you go with a 2-to-1, if you just give 40% win rate, you're still going to be in profit. So if you take the same thing, 100 trades and 40 you win and 60 you lose, you're still in profit, unlike the 1-to-1. So you see, and as your risk reward goes up, the win rate, it becomes lower and lower. With a 20% win rate, so you're only right 20% of the time. So out of 10, you're only 2 times right. With a 1-to-5, you can actually be in profit. So this is the relationship between reward to risk and win rate. And as a beginner, I would suggest you to stick with 2-to-1 actually. This is a very moderate, and I believe it fits everyone, especially the beginners. Now, as we discuss about the max loss and the risk management, we say that max loss is represented by the lot size. So for any specific trade, we gotta determine the lot size. That's gonna give us that max loss. Now, how do we calculate our lot size for a specific trade? We can use the MyFX book website. So just Google MyFX book position size calculator or the Baby Bips one. So both of those are very similar. You can see this is the MyFX book and this is the Baby Bips. Basically, all of what we're doing is filling those blanks here and then calculate, and it's going to show you. So basically, looking at the Baby Bips first. So account currency US dollar. So I do have $1,000 on the account and it's in US dollar. That's the first thing. Risk percentage. Let's say I want to risk 1% of my account in this trade, which means that I'm going to be losing 1% of my account, which is $10. Now, 1% here. And then for that specific trade, what is my stop loss? So is my stop loss in pips? What is the maximum pips that I want price to go lower before I close my price? And it's actually, for example, 15 pips. If price goes 15 pips below or above my entry, where I enter the trade, I would close my trade and I would lose 1%. So put those and the currency pair. For every currency pair, the lot size will be different. So for Euro USD, click calculate and it's going to show you the amount at risk is $10. And standard lots, we're going to be risking 0.0667 standard lot. Now the same thing goes here. Currency pair, the Euro USD, and it's US dollar, $1,000, and I'll be risking 1% here. The stop loss in pips is 15 pips. And the trade size, so if you click here, it's going to show you in units, but I put it on lots. So one lot, calculate, and it shows you right here that the sizing or the lot size is 0.07 lots. So very similar to this one. It's just that this one is rounded more. So this is how we calculate our lot size. It's one of the most important aspects and concepts to understand about trading. You got to calculate your lot size before entering any trade to confirm that there is a specific amount of money that you're willing to lose, not more than that. Now, before we go into MetaTrader and enter a real trade, what we're going to cover is the types of Forex orders. Now, we know that in order to trade, we got to have MetaTrader and execute the trade from there. But there are different types of order. Basically, the stop order, the limit order, and there is market order. The first one I'm going to cover is market order. Market orders mean entering as soon as possible with the best available price. So simply, if I click market order, it's going to open and it's going to give me the best price in the market. That's it. That's it. So very simple. And I do use market order sometimes, but there are two different types of order, the stop and the limit. Now the stop is when we have a buy order that is placed at a price level above the current price. So let's say the price is right here, right now. I'm having a specific level here, and I want to have a buy stop here, which means that my current price is right here. If it crosses above this level, I'm going to be buying. So this is more as a breakout trade. So if price close, I mean, not close, but it crosses above this level, I'm going to be entering. It's the same for the sell stop. So it's placed at a price level below the current price. So price is right here. I want to go sell, and it's a stop order, which means that if price goes below this level, immediately I'll be selling. I'll be entering here at this level, and price will go lower. Now, the opposite with the limit order. So limit order is my price is right here, for example, as of now, and I want price to kind of retrace down before I buy. So buy order is placed at a price level below the current price, and when this level is hit or reached, the trade is entered. So I'm right here. I'm going to be waiting for price to come here, and I'll be entering from here going up. The opposite with the sell limit. So sell limit, the current price is right here. I want to sell not when price crosses a level right here. So if we're looking at buy stops in this case, it's going to be like this. I'm looking for this level to be broken. If it goes below, I go sell stop. But in reality, I want price. So the current price is right here. I want it to go up. Then at this level, it will be executing. So it's going to be a little bit different. It's going to be at price level above the current price. When price reach that level, it's going to come lower, and we execute right here at this point. And as I said, market order, it means that if the current price is right here, it's going to give me the best price, and it's going to buy at the same level. So if I was right here, it's going to open here either up or down, buy or sell, short or long. Now, coming to this slide, you're already knowing all of the basics of the Forex, all of the fundamentals. You know how to deal with MetaTrader 4 for execution, and you know how to use TradingView for the analysis. Now, the next step is, first of all, you want to go on YouTube, look for different trading methods, and it's actually going to be confusing. So I'm telling you from now, I'm giving you a disclaimer that it's going to be a lot of work. They're going to go through a lot of different ways to analyze the market. You have trend lines, you have indicators, including moving averages, MACD, RSI, all of those, and also going into supply and demand. And you got price action, you got smart money concept, and you got ICT, you got Elliott waves, and you have a lot of different ways to analyze the market. Now, I'm not saying you're gonna cover all of those. I did. I know most of the ways to trade, but I did not master all of those. I go into one way of analyzing the market. I see if it fits me, if it fits my personality. I read about it a little bit, see if people are being successful with it, and then I move to another one if this one doesn't fit me. So that was my journey. You got to go through almost everything, but you don't need to master everything, and you don't need to spend a lot of time in each of those ways or each of those trading methods. Now, what are you going to do after identifying those methods, or after identifying each method? What you're going to do is backtest, which means that you're going to go back in time and you're going to see if this thing actually works, and if you can see it very easily in the chart, if you can identify that. If you can, and you're going to be using FX Replay, it's one of the best platforms to backtest. You can also use Tradingview, but you need to have the premium account or the premium membership, and it's going to be a trial and error journey. So you're going to backtest something, you're going to see that it doesn't work, you're going to go and backtest another thing. There is no shortcut in here. Then when you find something that is really working with you, what you can do is go and create your plan. So based on the trial and error, based on the backtesting that you have done, you're going to have a trading plan and try to follow that trading plan, and if possible, do the backtesting again based on that specific trading plan, and then start trading. So it's not that you finish this video and then you go immediately to trade and you put your money and you're going to make money. No, it's not going to be this. I'm being realistic here. It's going to take some time. As I said, it's a long-term thing, not a short-term. It's not gambling. It's the same as opening a project or opening a business, for example. It's going to take time to make money. First, you need to spend the time first to create the business, create the plan, everything. Then you need time to be a break-even. Then you get the profits. That's where your next move should be. I wish you all the best, and hopefully this was insightful guide to you and you learned something new.